So we are discussing the theories of capital structure or different views given by the experts about the capital structure and market value of the firm. Mainly there are four theories: net income, net operating income, Modigliani and Miller approach, and traditional approach. Up to this we have completed first two. Okay, the first one is NI approach given by David Durant, and according to this approach, if company use more debt capital in the finance, overall cost of capital will reduce and it will increase the value of the firm. And this is a relevant theories. Five assumptions are there. This is the diagram, and this is the formula. Okay, there's four things you need to remember, and you need to write in examination. Number two, NOI, net operating net operating income. Then it's fine. Net operating income approach, again given by David Durant, and this is the opposite of NI, totally reversed from the NI approach. And according to this approach, the capital structure does not affect the value of the firm. If the company use more debt capital, it will increase the cost of debt capital. Cost of equity capital. If the company use more debt capital, it will increase the cost of equity capital, but the overall cost of capital, average cost of capital remains same, market value of the firm remain same. This is the formula, and now we are in the third theory. Write down the title. Approach. In 2018-19, in final examination, there is one MCQ question. Stand for ... So stand for Modigliani and Miller. These both are the experts and both are working together on a different concepts. This approach was presented by in 1958. Maybe the question asked in 1 mark question, okay, in which year approach was introduced or presented. That is in 1958. According to this approach, the finance decision of the company does not affect the market value of the firm in a perfect capital market. So again, this theory is irrelevant theory. There is no relation between capital structure, financial decision, and value of the firm. In another word, said that the average cost of capital does not change with the change in the debt weighted equity mix or capital structure of the company. According to okay, they are saying that average cost of capital does not change. It means it remains same if company change the debt proportion or a capital structure. If I explain in a simple language, if company increase the debt, okay, or decrease the debt, it does not affect the cost of capital. Suppose right now company using the equity shares of rupees 5 lakh, okay, and debt capital for rupees 5 lakh. And the next year, suppose company use 3 lakhs of equity and 7 lakhs of debt, it does not affect or does not change the cost of capital, it does not change the market value of the company. Are you getting my point? बहुत ही सिंपल है कि अगर कंपनी ज़्यादा डेप्ट यूज करे या कम डेप्ट यूज करे, उससे कंपनी की एवरेज जो कॉस्ट है, एवरेज कॉस्ट वो चेंज नहीं होगी. अगर एवरेज चेंज नहीं होगी तो फिर उसकी मार्केट वैल्यू भी चेंज नहीं होगी. आर वी क्लियर? If company change the capital structure, it does not affect the average cost of capital, and that's why the market value is not affected by the changes in the capital structure. And most important line of this theory, that is, there is nothing which may be called as optimum capital structure. According to it is nothing like optimal capital structure or optimum capital structure. Why? Suppose your name is, my dear? Yes. Prisha. Okay. Your name is? Rahil. And your name is, my dear? Jaideep. Okay. Suppose we have three students in a class: Prisha, Rahil, and Jaideep. In FM internal, okay, in FM internal, I give you 29 out of 30 to Prisha. How many? मैंने प्रिशा को कितने दिए? 29 out of 30. I have given 28 to Rahul. 28 marks out of 30 to Rahul, sorry, and I have given a 27 marks to Jaideep. Now, Jaideep, are you satisfied with 27 marks? Okay, but somehow, somewhere, you will also compare your marks with Rahil. By chance, sir, if you have given me one more marks, I am equal to Rahil. Rahil now compare with Prisha. Suppose, sir, just one marks. If you give me a more, I am equivalent to Prisha. Now, Prisha what said? Sir, just only one marks. If you have given me only one more mark, I am securing 30 out of 30. Are you getting my point? So at one particular level, nobody is satisfied with the current position. Okay. Similarly, in complete forms of organizations, no companies are satisfied with their capital structure. They want something more, something beyond that the present level. Are we clear? हमारे पास जो भी है उससे हम satisfied right now नहीं. Are we clear about this last line? There is no optimum capital structure means the companies are not satisfied with the capital structure, thus give you the maximum benefit to the companies, maximum value of the company. Read out the assumptions. If this all the assumptions have worked properly, then and then this theory is applicable. The first one assumption is perfect capital market. According to the market is perfect. Number of buyers are there, number of sellers are there. All the buyers and sellers are price takers, they are not price makers. All the information is available free of cost. No transaction costs are there, and investors are behave rationally. All these conditions are fulfilled here. Are you getting my point? Perfect का मतलब है कि it is perfect from all the aspects. Number two. There are no retained earnings. There are no retained earning means no reinvestment of profit. Whatever the profit will generate from the business operation, all the profit will be declared as a dividend. Number three, no corporate tax. Number four, investors are acting rationally, and dividend payout ratio is 100%. Okay, already we have discussed it. No reinvestment means total dividend. Suppose company has earned a profit of rupees 5 lakh. Okay, this is the profit for the company. Now this profit may be categorized in or may be divided in two categories. Out of this 5 lakh, company has declared a dividend of rupees 3 lakh. This is dividend. So remaining 2 lakh will be considered as retained earning. But what is the condition here? That 100% dividend, no retention. It means this option is not available with the company. Company need to declare all profit as a dividend. So whatever the profit, here we have 5 lakh of profit. So this 5 lakh will be distributed as a dividend. No retention, no retained earning. Are we clear? And last one, the business risk remain same. Level of business risk remain same. So business risk remain same. 100% dividend. Investors are rational. No corporate tax. No retained earning, and perfect capital market. Are we clear about this? 6 conditions, 6 assumptions. At least you need to write any 4. Now, the theory that explained by the this theory, if two firms are there, in all the aspects except their difference in respect of their financing pattern and their market value. Let's take an example. Suppose there are two companies, okay? Company A, B, C, and X, Y, Z. It's fine, my dear. There are two companies, A, B, C, and X, Y, Z. Both the companies are similar. Both the companies are similar. There is no variation in the company A, B, C, or X, Y, Z. But except the difference in respect of financing pattern. Their financing pattern means capital structure. Suppose in ABC company we have equity shares of rupees 5 lakh, preference shares of rupees 3 lakh, and debt for rupees 2 lakh. And in XYZ company, we have equity shares for 5 lakh and we have debt for 5. Are you getting my point?
Yes, sir.
Okay, in ABC we have equity shares, preference shares, and debt. In XYZ we have equity and debt. Their market value. One, there is a change in capital structure, and second change in the market value. Suppose here market value we have 30, here market value we have 10. Are you getting my point? In company ABC, market value is 30. In company CXYZ, market value is 10. Now, what this theory said, now read carefully and try to understand. Then, the investors will develop a tendency to sell the shares of overvalued firm. Now, what investors do? Investors means you and me. What we do? We sell the shares of overvalued company. Which company is overvalued? XYZ or ABC? ABC company is overvalued. Market value of ABC is more. Okay, so we, all the investors are sells the shares of ABC. Are you getting my point? As we sell the shares in the market, this price will go down. And what happened in the second case? To buy the shares of undervalued company. Now investors like you and me, we are purchasing the shares of undervalued company. Or undervalued company means XYZ, and now we are purchasing the shares of XYZ. So what will happen as we purchase the more shares, this will increase. Are you getting the logic? Okay, whatever the companies we have, here company ABC having more value, more market value, so investors are sell their shares, and XYZ having the less market value, undervalued, so investors are purchase their shares. Now, this process, this pressure, sell, purchase, sell, purchase, sell, purchase, sell, purchase remains same until the two firms selling same market value. जब तक के लिए ये 30 में से डिक्रीज होते होते यहाँ पे 20 ना आ जाए और ये इंक्रीज होते होते यहाँ पे 20 ना आ जाए, एक बार ये 20 आ जाए उसके बाद ये प्रोसेस कम हो जाएगा. Are we clear? This process of buying and selling are continue until we get the same market value of both the companies. If we sell the shares of ABC, the price will down up to the 20. And as we purchase the shares of XYZ, price will increase from 10 to 20. Once they reach 20, its process is now over. Are we clear about this theory? Done? Write down the formula. V, value of the firm is equal to EBIT, earning before interest and tax, in bracket 1 minus T upon KO. KO stand for overall cost of capital. Then V is equal to EBIT 1 minus T upon KO. Look at to the diagram. Here we have KD, cost of debt capital, in the last line. And middle we have KO, overall cost of capital, and upper line represent the cost of equity capital. Initially, what happened? If company use more debt capital, if company use more debt capital initially up to a one particular point, the cost of debt will decrease, but overall cost and cost of equity will increase. But after that particular point, after that line, if the company use more debt capital, okay, suppose we are this point is 5 lakh. So if the company use the debt up to the 5 lakh, the cost of debt will reduce and overall cost of capital and cost of equity will increase. But if company use the debt more than 5 lakh, then what happens? Cost of equity and cost of overall capital will reduce, but cost of debt will increase. And this process, increase, decrease, remains same up to that particular level or a point where this three becomes in. Cost of equity, cost of overall capital, and cost of capital. Are we clear? Last theory of capital structure, traditional theory or traditional approach. This is something interesting because here we have cocktail. Do you know ना cocktail? इसको कहते हैं cocktail. Okay, a mix of two or three different varieties. See, it is the mixture of net income approach and net operating income approach. So traditional approach is a mixture of NI and NOI, and that's why it is also known as intermediate approach. It is also known as intermediate approach. Now, try to understand the concept. Mix of debt and equity capital can increase the value of the firm by reducing overall cost of capital up to a certain level of debt. Okay. Let me discuss this with a practical example. Okay. Suppose these two companies are there. Okay. These two companies are there. And here in both the companies, or let's take only one company. Chalo. Or easy. In XYZ, we have equity capital of 5 lakh and debt capital of 5 lakh. Total capital is 10 lakh. Suppose on equity, company paying 20% dividend. तो कितना होगा dividend? 20% of 5 lakh rupees 1 lakh. Okay, and on debentures, company paying 10% interest. कितना होगा? 10% of 5 lakh, 50,000. So it is 1 lakh 50,000. Are we clear? Okay. Now, what this theory say? If company use a mix of debt and equity capital, can increase the value of the firm by reducing overall cost of capital up to a certain level of debt. सपोज कि यहाँ पे कंपनी डेट को इंक्रीज करती है, कितना इंक्रीज करती है? बाय 5 लाख टू 7 लाख. सो हियर इक्विटी दैट इज 3 lakh and debt will 7 lakh. Okay, total capital remains same. Now calculate the 20% of 3 lakh, 60,000. 10% of 70,000, 1,30,000. Are you getting my point? If company use more debt capital from 5 lakh to 7 lakh, the cost of capital will reduce from 1,50,000 to 1,30,000. Now this process is remain continuous. Here company use, okay, 1 lakh of equity and 9 lakh of debt. So here this one means 20,000 and here we have 90,000, 1 lakh and 10,000. If this process is going again ahead, suppose company using 1 lakh of equity and 15 lakh of preferences. Okay, so what will happen? 20,000 here for equity and 10%, it means 1,50,000. This cost become 1,70,000. Now you can complete. Are you getting my point? Okay. If company use the debt capital up to a certain percent, from 5 lakh to 7 lakh, the overall cost of capital will reduce. 7 lakh to 9 lakh, overall cost of capital again increase. But if company use more than that amount, suppose here we consider that 10 lakhs. If company use more than the cost of, more debt than the 10 lakhs, then it will affect the capital structure. Are we clear? एक लिमिट तक हम उसको यूज करेंगे तो वो बेनिफिट करेगा, लेकिन उससे ज्यादा हमने यूज किया तो उससे क्या होगा? तो ओवरऑल कॉस्ट ऑफ कैपिटल विल इंक्रीज एंड एज इट इंक्रीज द मार्केट वैल्यू विल डिक्लाइन. आर वी क्लियर? जब तक कॉस्ट ऑफ कैपिटल एवरेज और ओवरऑल कॉस्ट ऑफ कैपिटल डिक्रीज होगी तब तक मार्केट वैल्यू बढ़ेगी. Once it is stable, market value stable. If the cost of capital will increase, market value of the firm will decline. Read out the assumptions, conditions. Number one, firms pay 100% of its earning as dividend. It means whatever the profit is there, all the profit is declared as dividend. No reinvestment. Total assets are given and do not change. It means no change in the total assets. Total finance remains same. It means total capital, total finance remains same. Operating profit, EBIT, are not expected to grow. It means profit remains same. Business risk remain constant. Business risk remains same. Firm has infinite life, unlimited life, and last one, investors behave rationally. So dividend 100%, assets remain same, no change in assets, no change in finance, no change in operating profit, no change in a business risk, unlimited life, and investors are rational. Are we clear? Yes, sir. Any doubt, any query? Generally, we ask any one theory in a 4 marks, any two theories in 8 marks, okay, and any one theory in again in 8 marks. If the theory is asked in 8 marks, you need to write a theory, assumptions, diagram, and formula. But if it in 4 marks, I again suggest that write everything but in short lines. Okay, write only 3 to 4 assumptions, write the concept or a theory in 4 to 5 lines, do the diagram, and write down the main formula. So with this, our theories of capital structures are over. Any doubt, any query in these theories? No? Okay. Now we are moving for practical aspect of this unit, and that is the fourth point. First point is sources of finance. Number two, no. Here this does not have formula. This theory is work like this. Okay. Uh, where I so up to this we have discussed sources of finance, theoretical part. Then after we have discussed cost of capital, practical part. Then after we have started a discussion about capital structure, theoretical part, and now the fourth part of this unit, and that is leverage. Write down the title, leverage. We have some practical questions from this point. Three types of practical questions are there because we have three types of leverage. Title done. टाइटल लिख लिया सबने those are here in online mode. Have you written the title? Okay. First, just we try to understand the concept of leverage. Okay. The question may be asked to define the term leverage. Okay. So the term leverage refers to an increased means of applying some purpose or this is the general meaning. It is not applicable to us. For us, the financial point of view of leverage is important. So second para is very important. Leverage refers to furnish ability to use fixed cost assets or a fund to increase the return to its shareholders. So here leverage means use of debt capital in equity sorry in capital structure. Again I repeat leverage means यहाँ पे जो लिखा है इससे बेटर है कि मैं जो बोल रहा हूँ वो लिखो. Leverage means use of debt capital in capital structure. ये एक लाइन क्लियर है. Use of debt capital in capital structure. Here debt capital means a capital or a finance in which company need to pay fixed percentage of return. Suppose company using 10% loan, 5% debenture, 8% bonds. So in this all the securities the return is fixed. On a loan 10% return, on a debentures 8% return, on a bonds 12% return. So when company use the debt capital, at a time company have leverage. In any company, if only equity shares are there, it means company does not have a leverage. Are you getting my point? In any company, if we have only equity shares, it means company does not have any leverage. Definition given by James Wan: the employment of an asset or a fund for which firms pay a fixed cost or fixed rate. जो मैंने बोला था वही यहाँ पे भी बोल रहे हैं but in different ways. They are saying that employment it means use the employment of and fixed assets or funds. Fixed assets or funds means debt capital in which we need to pay fixed return. The firm pay a fixed cost or fixed return. Are we clear about the concept? Leverage means use of fixed assets or funds in which company need to pay a fixed return or a fixed cost. Now, this is important for all of you. For a theoretical question, for a practical question. Leverage, specifically, types of leverage. There are three types of leverage: operating leverage, financial leverage, and composite leverage, also known as combined leverage. If we combine financial leverage and operating leverage, we will get the sorry. If we combine operating leverage and financial leverage, we get the combined leverage. So combined leverage is a multiplication of FL and OL. Later on, we will discuss with the practical question. Just write down the title only, types of leverage. And in the types of leverage, first we have operating leverage. Operating leverage. The leverage associated with investment activities is called as operating leverage. The leverage, if it is associated with investment activity, it is known as operating leverage, and it can be defined as company ability to use fixed operating costs to magnify the effect of changes in sales on its earning before interest and tax. So if I explain this entire para in a simple line, then I can say that operating leverage means measuring the impact of changes in sales on changes in EBIT or operating profit. वापस से एक बार रिपीट करता हूं. Operating leverage means measuring the changes in sales and changes in operating profit. Operating profit means earning before interest and tax. Let's take an example to understand this. Suppose in the year 2020, company has sales of rupees 100, and this is the sales, and here we have profit of rupees 10. Now see here, in 2021, company has increased the sales by 20%. So here we have 120. According to that, how many percentage will increase in profit? Well, are you getting my point? If the sales is increased up to 140, here we have 14. If the sales will increase by 200, here we have 20. Reverse case is applicable also. If the sales will decline by 10, here 9, the profit will be 9. If the sales is 80, profit will be 8. Are you getting my point? So this entire process or a system is explained by operating leverage, and that is said that if company change the sales, it definitely affect the profit of the company. So changes in sales and their impact on profit that represented by the operating leverage. In operating leverage, we have only two important costs. One is fixed cost and second one is variable cost. Fixed cost means a cost which is remain same in respect to your production, in respect to your output. For example, salary of factory manager, rent of factory. Suppose I have rented this classroom for my tuition classes purpose. Okay. Now we have 72 seats here. Suppose we have 72 seats and I am paying a rent of rupees 30,000 per month. The rent is fixed. Now if I can bring a 30 student in a class, or if I bring a 3 students, or if I bring a 60 students, or a 70 student, or a 75 students, is there any change in the rent? ओके अगर मैं 3 स्टूडेंट लेके आऊँ 30 लेके आऊँ 50 लेके आऊँ 70 लेके आऊँ the rent remains same in respect of number of students. But if we talk about the collection of fees, then definitely it will differ. Collection from student, 3 students is different, 30 students are different, and 50 students are different. So here rent is considered as a fixed, but the students' fees are considered as variable cost. Are we clear? Now, this line, this para will help you in practical questions. Okay, read the first one. When the company is said to have high degree of operating leverage, if it employs a great amount of fixed cost and small amount of variable cost. If company have more fixed cost, if company has more fixed cost, it means the operating leverage is high, and high operating leverage means high risk, more risk. Please note down somewhere in your book. High fixed cost is equal to high operating leverage is equal to high risk, more risk. Last slide for today's session. Write down the formula, and from the next class we will go for practical questions. Formula is OL, operating leverage, is equal to C upon OP. C stand for contribution and OP stand for operating profit. Your contribution will find by sales minus variable cost. Contribution is equal to sales minus variable cost. In some of practical question, contribution is directly given to you. In some of book questions, it will not given to you. You need to find. For finding out the contribution, you need to use this formula: sales minus variable cost. P is equal to S minus V. And operating profit means profit before interest and tax. If it is given to you directly, use it. If it is not given, then OP is equal to sales minus total cost. Operating profit OP is equal to sales minus total cost. Total cost means variable cost plus fixed cost. Are we clear about this? So from the next class, we will go for a practical question of the financial leverage. We are ending this session with this. So write your enrollment numbers for attendance purpose and you are free to leave the class.